Unity Software stock strikes me as an unrivaled company with hyper growth. I'm really excited about their business prospects as they play a key role in the gaming industries as well as 3D rendering in general. I look at huge growth prospects in the years ahead, and management is very confident in continued growth. And so in this video, I'm going to talk about the latest news as well as their underlying business segments, how are they performing, as well as the current valuation. If this is your first time tuning in, my name is Daniel and you're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in Unity. So the big news out of Unity this past quarter, their third quarter, was their agreement to acquire Peter Jackson's Weta Digital, the tools and intellectual property used by the Weta VFX team to make spectacular movies like War for the Planet of the Apes, Avatar, Lord of the Rings, and Wonder Woman. You're talking about the incredible special effects that are required to make these movies. These are the tools that were used to make it. This acquisition is about accelerating the pace by potentially years of bringing amazing tools to creators. It includes a library of content, think characters, terrain, vehicles, equipment, etc. So new creators won't have to reinvent the virtual wheel. This is a huge competitive advantage versus anyone else looking to potentially compete in the years ahead. Weta VFX will remain independent from Unity, but will license back their tools for $50 million plus a year going forward for at least the next 4 years. While the $1.6 billion acquisition of Weta Digital helps accelerate their growth and Unity's broader mission to democratize incredible 3D rendering tools for artists around the world, the reality is that their core business segments are still doing extremely well. Their Create business segment, for example, is about licensing new seats to access their incredible 3D rendering technology. During the year-to-date third quarter 21, Create Solutions grew revenue by 38%. As you can see here, they talk about how the seat per year cost is $1,800. These are some really powerful tools and are needed for these creative individuals. Keep in mind that management's goal here goes beyond gaming and entertainment, as effective and true digital twins make it easier to model and predict real-life outcomes. For example, several major auto manufacturers are working with Unity for a variety of reasons, including design visualization, autonomous driving simulations, and VR maintenance training. Their gaming division, aka Operate Solutions, is still the majority of their business, however, and it's about 65% of their third quarter 21 revenue, and growing even faster. Year to date, their third quarter 21 revenue was up 53%. You can see on this slide all the different ways that they consider monetizing their operating or their gaming channel, including hosting games, community tools like providing chat interface, helping to acquire users, and optimizing for ad revenue. Management believes that not only do they have a best-in-class asset here, as half the world's games and 70% of the world's mobile games are already built on Unity. I mean, just think about that. That is an incredible metric. Half the world's games and 70% of the world's mobile games are already built on Unity. But they think that the revenue inside of gaming, so gaming-related revenue, can still increase by a 10x magnitude. This is management's outlook as they enable more creators to build around the world, and their 3D technology becomes the norm as more and more games effectively say, hey, the tools are so easy to incorporate 3D, we might as well, because that's just a better feel, and it's a really cool tool, and it becomes easier to build with using Unity's tools. Okay, so what about valuation, given that this strikes me as really an interesting company with hyper growth, lots of potential? First, a quick plug, where if you're interested in joining a community of fellow investors looking to learn and find exceptional companies, we have an exclusive community on Discord where I interact almost daily. You can sign up at unrivaledinvesting.com, click Join the Journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. Once again, that's at unrivaledinvesting.com. Click Join the Journey. And if you enjoy videos like this, really do appreciate that thumbs up and hit that subscribe button. So a few factors that we should consider as we think about valuing Unity. First, they offer a critical tool to their customers. I mean, this is really important for the folks that are, let's say, in the virtual effects, business. This means when you have a critical tool, this ultimately translates into stickiness and pricing power, where you can raise, revenue over time for your customers that are stuck with you. You can see how their net expansion rate has improved over the last few quarters, where in their third quarter 21, it was 142%, and that's up from 133% in the fourth quarter 2019. These metrics are fantastic, 142%. It also implies that without onboarding any new customers, their business would have grown by 42%. That's what this metric means. 142% means their growth rate would have been 42% without any new customers. The reality is that there's potentially two sides to this story, however. For example, their year-to-date consolidated revenue growth is only 44% now. Maybe I should say only 44%. But given that their net retention rate is 142%, it really does raise this question. I mean, you should think about this. I mean, the 142%, once again, implies without onboarding any new customers, their year-over-year growth rate would have been 42%. But their consolidated growth is 44%. This means they spent hundreds of millions of dollars on sales and marketing to onboard new customers that incrementally added only 2% net revenue, or about 10 million, a little over 10 million in revenue. That strikes me as really weird. So I'd want to understand that in greater detail if I were a bull or if I owned Unity stock, because it seems like they're spending hundreds of millions of dollars for little in terms of new customers. What I suspect this primarily reflects, this sort of question is how far ahead Unity is with the tools that they've built, how they've invested so significantly into cool tools and amazing features that they have to spend hundreds of millions on sales and marketing just to educate the marketplace, the non-gaming industries, about what's available. For example, they recently launched Unity Metacast, designed to capture 3D sports for creating and delivering content directly to the consumer. They've announced a partnership with UFC that might someday impact how fighters train, referees officiate, and how viewers replay reality. Despite this significant investment, management expects immaterial revenue near term from this partnership, and I think this reflects one of many examples where Unity's building out really cool tools, really cool potential features, but it doesn't necessarily translate into revenue right away. Despite the stock falling about 40% from its recent highs, Unity stock is still really expensive, around 35 times 2021 sales, 25 times 22 sales. Their market cap is also about 15% higher than a lot of people realize. I think on Yahoo you might see it closer to 35 billion versus the 40 billion. While they're significantly unprofitable right now, even assuming huge profit margins in the future of, let's say, 25 to 35% profit margins and an end PE multiple of, let's say, 35 to 45 times, and let's say annualized growth rate of about 40% over 5 years, it still doesn't strike me as a crazy risk reward in this hypothetical scenario that I'm penciling out with 35% optimized margins, over 40% annualized growth, and a 45 times N multiple. You're still getting less than 100% upside. And keep in mind, stock prices can go way higher and lower, and if they don't execute, I'd expect the stock to go significantly lower. So if they deliver, let's say, much lower than 40% annualized growth, then I'd say the valuation and the return potential is really a lot of downside given their very full valuation. Honestly, I look at Unity and it strikes me as an unrivaled company, but it concerns me about how full their valuation is, and it makes me wonder if the stock might not go anywhere for the next few years, but maybe it'll just do it in a really interesting and volatile way, as shareholders have seen recently. If you have a strong take on this where you're like, oh, Unity, I'm a mega bull and here's why, I definitely want to hear it. I just, once again, I think there are better potential multi-baggers out there. If you enjoyed this video, please make a point of hitting that thumbs up and hit the subscribe button. Thanks so much for tuning in.